Why is it more complicated to finance a condominium versus a single family home or a townhouse?
That is a great question. I think what happens with a condominium, I think ultimately the difference is that there are rules set aside for condominiums. And if I had to kind of make an educated assumption, I think part of it is that when you buy into a condominium project, the condo actually takes care of the outside of the structure. And so when you buy a single family home or you buy a townhouse, the individual homeowner, even though they might be part of an association, is actually responsible for the building that is being financed, right? The actual structure. But in a condo, a third party is responsible for the actual structural integrity. So I think that's probably the reason why condos have an extra step involved in the financing process that a single family home or a townhouse, even if it's an HOA, would not have.
My name's Steven Wang. This is Rich Brandt, the Loan Doctor. This is the Loan Doctor podcast. Welcome to our waiting room.
I think we're going to be talking about condos today.
Exactly. So, Rich, Fannie Mae just announced new guidelines. Why does this matter and why the change?
Well, I think they announced new guidelines, so there's a few reasons why they did it and why it kind of matters. I think one of the things that Fannie Mae recognized is that insurance is getting harder. It's harder to get insurance, especially here in Florida. And one of the unique things about the state of Florida, and I know that we do loans nationwide and people are listening that aren't necessarily in Florida, but Florida's unique in that Florida and Hawaii had like its own set of guidelines when it came to financing condominiums from Fannie Mae. So the insurance is getting more expensive. Condo associations also aren't always run in a fiscally responsible way. So if you're a person looking to buy a condominium, you want to make sure that the project, that the things that you don't control are being run well. Because if they're not being run well, you as one of the project owners are now responsible. It's almost like being involved in a business, right? If the business isn't run well and the business has to stay open, well, if there's a deficit, who's going to have to make that up? The individual owners of the business, and in this case, the individual owners of a condominium. So it's real important that when you buy a condo, that condominium project gets properly evaluated to make sure that it's a good investment for the consumer. The bank isn't trying to be difficult. The bank is selfishly protecting their investment, right? Because they're doing the mortgage, but they're also protecting the homeowner or the buyer, depending on the situation.
What are some of the changes that make the process easier?
So with the new guidelines, some of the changes that make the process easier is there's no the project review is that part that's actually gone. There is no more project review. That part makes it a little bit simpler. One of the things that's also gone with the project is no investor concentration. It used to matter when you would buy into a condominium, if you weren't going to live in the condominium and there were a high concentration of other investors, the project would be ineligible. Now that's no longer the case.
What's gotten stricter?
Stricter?
Yes.
Well, the things that have gotten stricter are the budget. Now instead of the old rules were that a condominium had to have a 10% budget allocated for reserves, right? Of whatever the annual budget was. Now the new requirement is 15%.
Wow.
The other thing that changed is you can do a reserve study. So that if sometimes a condominium might have like a surplus of money, right?
Right.
And so because they have this surplus of money, they aren't collecting the 15% reserves that they need that are the minimum requirement. And so a reserve study basically says, hey, you don't need to. This is what you need to collect based on this. So the guidelines for reserve study, those got a little bit stricter too, a little bit more detailed. And the third thing that got eliminated is the limited review. There used to be when you were looking at a condominium, you had two different options depending on how much of a down payment was being made. You could do a full review or a limited review. And sometimes a project would pass a limited review, but not pass a full review, where that limited review went away.
Okay.
And one of the questions had to do with budget. And this is kind of a big topic because I think earlier you asked that the question was Fannie Mae made the change, right?
Right.
And why does that matter? So when you're getting a loan, most loans today are sold on the secondary market. They're either sold to Fannie Mae or Ginnie Mae or Freddie Mac, right? Those are the secondary markets. Fannie Mae and Freddie Mac are not government run. Ginnie Mae is at like FHA and VA. And so what those secondary markets do is they set the standard for what a condo project, what kind of condo project they will accept and finance. Okay. Now, if you're out there looking for a loan and Fannie Mae and Freddie Mac, the rule only applies, right? If you're in a regular area, if the loan amount is under $867,200, I think the number is, it only applies for that. If you're in a high cost area, the number is different, but that's not important. What's important though is, let's say you were buying a condominium where you were going to need a loan of $1.5 million. It doesn't matter that it's not that the loan can't be sold to Fannie Mae or Freddie Mac because it's above their limit. But what happens is whichever lender you're using is using their guideline to determine, is this project something they would buy or something they would finance or not? Mm-hmm. And if it's something they wouldn't finance, regardless of the loan size, it's going to end up costing the consumer a little bit more. Mm-hmm. It's not the end of the world. It's not horrible. It's just something that is.
Why are reserves such a big deal?
Well, I think we if you look at Surfside, in Florida a few years ago we had a condominium collapse because it was not maintained properly, and so reserves are important because you want to make sure that a project is able to has the money to make the repairs that are necessary before the repairs get bigger. It's kind of like, when you think about maintenance, right? If you properly maintain the property because you're adequately collecting then small problems don't turn into big problems, right? And when small problems turn into big problems, they also turn into big costs to remedy. And if they turn into big costs to remedy, what happens? People have special assessments. People they end up having to finance, so now you're paying interest. Or all kinds of negative things happen if you're not being, if you're being reactive instead of proactive. Because fundamentally, that's all reserves are. Reserves are a proactive way to know what is going to happen in the future, right? Mm-hmm. To be prepared for what's going to happen in the future. That's probably a better way to put that. A proactive way. A reactive way is you wait for shit to happen and then figure out how you're going to pay for it. Mm-hmm. So that's why reserves are so important.
Excellent. How have the changes affected insurance?
So that's another good question regarding this. And I'm glad you asked. Completely unsolicited. So a couple things they changed to make insurance more affordable for the condominium. One, they got rid of they used to require that a roof have replacement cost coverage. And if you have a 20-year-old roof or a 25-year-old roof that still functions, that's very, very expensive on the insurance side. So what they did is they changed it because you're now going to have this required reserve requirement, that higher reserve limit, that now you can get actual replacement cost value on the roof. Mm. So if you have a condo project that has a $2 million roof, right, but it's 25 years old, so it's only worth $200,000, you're going to get coverage for the $200,000 if the roof damages, and the condo association is going to have to come up with the rest of the money. But again, if they've got the adequate reserves and everything like that, that's not going to be a problem.
Okay.
The second thing that they did was they changed the maximum deductible or the minimum deductible to $50,000, maximum deductible to $50,000 per unit. So that also helps with reducing the cost of insurance because there used to be a different cap on the individual dwelling coverage on a master insurance policy. And thirdly, they got rid of the inflation guard requirement.
Rich, can you tell me what is inflation guard?
So that goes back to the guideline thing. And inflation guard has to do with insurance. It's not really something that I do, but one of the elements of the new guideline is that the inflation guard from an insurance policy, the inflation guard got removed. Inflation guard is something that somebody can get on their homeowner's policy or their condo policy, or that the master insurance policy for a condo used to have to carry. Inflation guard, what it did was it increased your coverage limits to account for rising cost in construction and all that. Now that's no longer required because you have this higher reserves that's based on what you're actually paying. So what they did was they removed inflation guard, which is going to drop the cost of insurance to make master insurance policies for condo associations more affordable.
That's good to know. What does the HOA insurance not cover on a condo?
So when somebody's buying into a condo project, the HOA covers essentially the outside of the building. So everything essentially from the walls out. So a lot of times people don't realize that everything from the walls in is not covered. So your flooring isn't covered, your appliances aren't covered, your cabinets aren't covered, the walls on the inside aren't covered. So you got to make sure that when you're buying into a condo project, that you get a policy, it's called an HO6 policy, that covers everything from the inside of the unit, and the HOA doesn't cover any of your personal items.
So what should buyers look for if they're thinking about buying a condo?
If you're thinking about buying a condo, you want to make sure that your agent, and I know you, Steven, and your wife at the Aubrey Hutchinson team,
Yep.
What you guys are really good at, and what anybody should do who's thinking about looking for a condo, is they want to make sure that they're checking to make sure they want to look at their budget. They want to look at the financial picture of the condo. They want to know what the insurance situation is, and they also want to check for any deferred maintenance, and you can really just look around for that, because deferred maintenance is kind of a big issue. Mm-hmm. When you talk about will Fannie Mae or Freddie Mac buy this project, they don't like deferred maintenance.
Okay.
Standard maintenance is okay, but the other element you want to do is it's not just your building, it's not your unit, it's not your building, it's the whole project. So if there are 10 buildings in a project, and one of the buildings, which like you're building 1 and the building that's a problem is building 10, that still is a problem. So that's just something for you to be aware of. And it doesn't mean you can't get financing. It just means the financing might change a little bit, and you have to go to a lender that will do a mortgage on a condominium that Fannie Mae or Freddie Mac won't securitize.
Okay.
Like me. We do that.
How do you help navigate this?
Well, just the things that we're talking about, right? I think one of the things that I've learned about this business is there are a lot of people who do what I do who are really, really good at taking your information.
Right.
They're not so good at doing something with it. And so we, me and the rest of my team at the Brandt Lending Team, we kind of understand the guidelines, understand the rules, and are able to help navigate through them and kind of address any situation that might come up to make it easy. And we're upfront about it, because a lot of times people get surprised, and so we make sure those surprises go away.
Okay. And what is the biggest takeaway from these condo rules?
The biggest takeaway from these condo rules, I would say the biggest takeaway is that the new condo rules are going to make some projects easier to finance.
That's great.
And it's going to make some projects harder to finance.
Okay.
So that's kind of the takeaway.
I'm Steven Wang. This is Rich Brandt with the Brandt Lending Team. And this is the
Loan Doctor Podcast. Thank you for being in our waiting room.